In this lesson, we're going to explore the next law of Wyckoff theory, and that is the law of cause and effect. Cause and effect is the idea that nothing happens by chance. Everything that comes about has to come from some cause that originates and creates it. So for every effect, there must be a cause. In the terms of trading and markets, we look at that in terms of accumulation and distribution being the cause, and the resulting trend, whether it's up or down, being the effect. Then you view all that through the lens of smart money and dumb money to understand how price varies and how coins or assets change hands in those areas. So what does that mean? Causes are constructed by the smart money. When you see a range that turns into a trend, you see that range in hindsight and you look at it and say, that is where smart money was accumulating before they pushed it into an uptrend. But in terms of looking at the cause as well as an individual trade, you should also view it from a broader perspective. You want to see the movement of the market. So when price goes sideways, you see that as building energy, like I touched on in the last lesson, and building up momentum so that it can break in one direction or the other. This is where smart money positions itself on the right side of the upcoming trend. And because they have the strong hand, they've got the money, they've got the combined weight of capital. Wherever they dictate for the market to go, in totality, the market will go. Looking at it in terms of back to a schematic. So before, we were looking at accumulation, markup, distribution, markdown. So just overlaying the idea of cause and effect onto that should give you a nice insight into why things, they don't just move randomly. The effect, whether that be down or up, always has a preceding cause, be that distribution or accumulation. That's it. If you see these ranges of accumulation and distribution, you know with high probability that when that breaks, the effect will be measured and in proportion to that preceding cause. What does that mean? A big cause will create a big effect. A small cause will create a small effect. Meaning, a long, lengthy accumulation will create a longer and more sustained trend up than a short accumulation. It's really that simple. You think of it in terms of days, weeks, months, even years sometimes. That's why when you break out of a multi-month accumulation, you don't expect the trend to end after a week. You expect it to move and move significantly. One thing, though, that is important to note is that not every range is accumulation or distribution. It's really more of a process. And this is why you want to view Wyckoff, first of all, through the lens of higher time frame. This schematic that we're looking at on the screen is most reliable on a multi-week or month basis because it happens on all time frames. It goes trend, range, trend, range. But you don't want to look at a 1 hour accumulation and think that that's going to produce a significant move. A lot of times, price will just move randomly in that range. For Wyckoff's theory to hold true, there has to be large institutional smart money interest. In crypto, you call it whales, call it smart money, call it institutions, whatever you want to call it. There has to be that buyer or seller present. That's why on a short time frame, say a couple of days on a 1 hour chart, you can't guarantee that there's actually any significant interest there. It might just be fluctuating because markets just move all the time and it might be moving rather randomly. If you look at a particular example, very common, is weekends in crypto. So here in the blue box is roughly the end of a Friday session all the way to the end of a Sunday session. So from Saturday and Sunday, large traders, institutions, the smart money doesn't typically show itself on a weekend. So you see these type of ranges. It's best not to look at this on a low time frame and start to draw Wyckoff schematics and look for accumulation and distribution signs. Generally, it's just going to be a random range fluctuating between a high and a low, finding support, finding resistance, until bigger interests enter the market, and on the higher time frame, we get to see some type of clear accumulation or distribution. Just important note, because it's easy to jump in and think that every range must be accumulation or distribution. Sometimes they're just not. That is the law of cause and effect. That's the second law of Wyckoff theory. And now we'll get into the third law, if you see, by going through to the next lesson.